So hello once again and welcome to the October buy-to-let mortgage update. My name is Richard Purnell. I'll be taking you through what's going on in the buy-to-let mortgage market for this month. Just before I get into the content, remember that if it's something that you want to hear more of, then just click on the subscribe button below this video, and so you get notified for all the videos that we put out there. Really appreciate that. Okay, so let's get into it. First of all, we've got the usual commentary about the Bank of England mortgage rate. Still stubbornly sat there down at 0.1%, which I guess we're quite pleased about, really, because that has an impact on mortgage rates. What's the prediction? Well, my personal views are that there's going to be nothing happening this year. Getting into 2022, possibly going 1/4%, and then into 2023 up to 0.5%. So in other words, really slow, really steady incremental increases, and therefore don't expect, as far as links to the Bank of England rate are concerned, any dramatic changes in mortgage interest rates. So good news for us landlords. Okay. Has been big news, of course, every time you switch on the TV. Furlough ending at the end of September. Now, the HMRC have said that 1.6 million people were on furlough at the end of September, a huge number. So here's the question. How many of those are homeowners? There's no stats out on that I can find. But the banks and the building societies are obviously nervous, concerned, worried about what's going to happen to their mortgage customers as we get into the last quarter of this year. The really interesting point is that for those that are going to be genuinely in financial distress, genuinely going to be struggling to pay their mortgage, the only thing out there from a government point of view to support them is something called the Mortgage Interest Loan Scheme. You may not have heard of it. It's because it's bloody difficult to access. You've got to wait for 39 weeks before you can access this pot of money. 39 weeks. What a complete waste of time. You're going to have your house repossessed by that time. Banks and building societies are not going to wait 9 months if you're not paying your mortgage for this to kick in. So there is a lot of lobbying in the background to try and get the government to reduce that to maybe 13 weeks so it becomes something useful post-furlough, but not yet. So what are the implications? Well, maybe fairly obvious that the banks, building societies are expecting a real spike in mortgage arrears. What does that lead to? Repossessions. Now, of course, from a landlord perspective who's active in the market looking to buy, then of course, there is going to be more below market value properties. How many? Obviously, we're going to have to wait and see in this next quarter and into quarter 1, I guess, of 2022. And also, what's going to be the impact on property prices? So there's all the experts out there are looking with deep interest to see what's going to happen in these next few months. Standout deals for this month. I've been seeing for a number of months now, certainly on the residential side, that there's been some eye-catching interest rates at below 1%. So you can imagine it's a marketing executive's dream to be able to put out there on social media, on posters, leaflets, etc., get your 0.99% resi mortgage. Well, it's now come to the buy-to-let world. Yay! So the mortgage works are now offering a 0.99% buy-to-let mortgage. Well, that sounds good, doesn't it? Except there's never such thing as a free lunch because it comes with a 2% arrangement fee, which, ouch, that can be expensive. It's okay if you've got a 50 grand buy-to-let mortgage. That's what, £1,000 arrangement fee, which is frankly pretty average in the buy-to-let world. But what if you've got a £500,000 buy-to-let mortgage? Oh my God, that's a £10,000 arrangement fee. That sticks in my throat even saying it. So be really careful about the headline grabbing interest rates out there. I did look a little deeper, particularly with the mortgage works, and they do offer an interest rate slightly higher. It's 1.25%. So it's a 0.25% increase in the rates, but it's got a fixed arrangement fee. And certainly for those of you landlords that have got those slightly above average mortgages, or maybe even London based properties with buy-to-let mortgages, then looking at mortgages that have a fixed fee could really be of interest to you. So bear that in mind. Now, also, we've got a company called Foundation Home Loans. They've been around there a while, so they're certainly, as far as brokers are concerned, they're a well-known lender, but they're not a bank, so you're never going to see them on the high street. But their bread and butter are portfolio landlords, so it is a lender that you may well come across in the future. Now, they've just brought out a 5-year fixed at 3.34%, which on its own, just as an interest rate, is pretty up there. It's really competitive. But on top of that, no arrangement fee. Now, that is unusual. 5-year fixed to have £1,000 and more arrangement fee, not unusual at all. So Foundation are really stirring it up here, offering a really great 5-year fix and with no arrangement fee. Now, here's the knock-on positive effect if you were interested in this one. And it's all about how much you can borrow, which, as landlords should know by now, you're keeping educated, then you know that it's the rental income that translates into a pound amount of borrowing. Now, just to keep things simple today, usually the rent has to be, let's say, 1.5 times your interest-only mortgage payment. Okay, you get your head around that. But what interest rate do you use when you're calculating that formula? Well, the banks use an artificially high interest rate. Not unusual to see 5.5% as a figure that's used. So your rent has got to cover the mortgage interest only payments using this artificial rate called a stressed rate of 5.5%. Now, here's the thing. If you take this Foundation mortgage, then Tipex out 5.5% and replace it with 3.34, and all of a sudden you can borrow significantly more based on your rental income. Now, it is subject to your loan to value limits, and this is 75%. So as long as you don't bang your head on that particular ceiling, then you can borrow significantly more money than the traditional method. So bear that one in mind. Now, finally on this slide, happy 25th birthday to the buy-to-let mortgage. Now then, yeah, this is from Tesco. That was slightly underwhelming, wasn't it? So, yes, would you believe it's the buy-to-let mortgage's 25th birthday? I bet you thought that it had been around there a lot longer, a bit like me, but no, only 25. It was Paragon and NatWest that were first asked to come up with this new mortgage, and they did so back in 1996. And would you believe today, when you look out across your town, city, street, 1 in 5 houses are now owned by a private sector landlord. Wow, what a success story. But as someone once said, with great success comes great responsibility. And would you believe that since 1996, 168 pieces of legislation have been issued for the buy-to-let mortgage sector and you guys as landlords. So it has never been more important than now to be educated about buy-to-let mortgages and what's going on there, which sort of leads me on to my 60-second spotlight, because the body that's behind a lot of this legislation is someone called the PRA. And I'm going to guess that you've never heard of the PRA. It's the Prudential Regulation Authority. Probably doesn't help you. Now, it's part of the Bank of England. And they're the ones that are behind the scenes setting the rules and the policies for the significant amount of buy-to-let lenders out there in the country. So you need to be not aware necessarily of the PRA, but you need to absolutely be aware of all the rules and regs that might be pertinent to you. And I want to just spend this next minute or so just picking out some of the main things that you should have on your radar to be thinking about, because it's the PRA that are telling the buy-to-let lenders to be doing some extra due diligence and checks in certain areas on you guys. Now, particularly if you are a portfolio landlord. Now, again, it's the PRA that defines what a portfolio landlord is. If you don't know, excuse me, it is if you own 4 or more mortgaged properties, this buy-to-let properties. So if you're buying number 4, then that lender's going to say, this person is now going to be when he or she owns this fourth property, will become a portfolio landlord, and that triggers a whole new set of checks, and as I said, due diligence by the underwriters of that lender. So you need to be mindful and aware, and be planning to make sure that you're going to pass these extra checks as this portfolio landlord. So what are they? Well, first of all, the PRA say to these buy-to-let lenders, make your portfolio landlord complete a business plan. Make them complete a cash flow statement. Now, for our clients, we complete these documents as best we can, probably 90–95% of them, and maybe get them checked off by our client. So we try and really do the heavy lifting on these documents. And obviously it's important as to what you're saying, what your strategy is as a portfolio landlord, what your future buying plans are, why you're getting into it, which hopefully you know anyway, but if not, it's not a bad exercise to get into, but your lender's going to be asking for that information. The next thing is a portfolio health test. Now, even if the property you're wanting to buy is fantastic, it ticks every single box, it's got great yield, it's in a great area, it's going to let all day long, so it's a fantastic opportunity. The lender's going to say, well, that's all well and good, but what about your background portfolio? What about these other 3, 4, 5, 6, whatever properties you've got in the background? I'm going to do some checks on these, and if they fail, we don't care how good the properties that you're buying, we're going to decline you. So therefore, you as a landlord need to be aware of what these checks are. I'm just going to point out the two main ones. The first one is, what's the overall loan to value of your portfolio? So let's say you've got 5 properties in the background. Now, the lenders generally do not look at each individual property. So if you happen to have one in negative equity, you're okay, so long as the remaining portfolio bring the overall loan to value under 75%. So write that down. 75% is the magic number. And by the way, don't artificially increase the values of those properties to make it fit 75%. They'll do some stress tests of the values to make sure they look realistic. So, you know, don't be fooling yourself here. So that's the first thing. The second thing is this stressed rate coverage. Again, a little bit of jargon, but they're going to be looking at what the overall rental income is of that background portfolio. And again, is it paying the mortgage payments? And it's, for many landlords, it might look healthy because interest rates are quite low at the moment. And if you've got mortgage interest rates on your background portfolio that are quite low, it clearly looks on the surface that you've got extremely positive cash flow. Well, the lenders don't look at it from an actual point of view. They're again going to use an artificial interest rate to see that your rent is paying those mortgage payments at a higher rate. I think it's something that you guys should be doing anyway. If you're not, then, you know, work it out at 5%, at 5.5%. Is your rent covering those payments when the mortgage rates go up? They are going to go up at some point. So, you know, you should be doing that exercise anyway. But if not, your lender is going to do that. And if it fails that test, you're going to get declined. So make sure that you go through those 2 points. Okay. Life insurance, just want to touch on it really briefly. I do every month, make no apologies for it. Here's a quick question. Is your life insurance in trust? If you do not know whether it's in trust or not, or in fact you do know, you're quite positive that it's not in a trust, then please, please, please make an appointment. You'll see how to do that on the next but one slide with one of the team, one of our advisors, and we'll tell you why it needs to be in a trust, how you can do it. Certainly for our clients, we don't make any charge, but it can look a little complicated on the surface. The reality is for most people, it isn't. But there are 2 massive benefits in doing so. One, that it can protect against paying inheritance tax, which can be an arm and a leg. And second is about speed of payout. If it's not in a trust and it gets locked into probate, it can be months and months and months before your beneficiaries get the payout that they desperately need. Whereas if it's in a trust, it's not part of your estate, it's not part of probate. So therefore, your executors can knock on the door of the insurance company within days, within a couple of weeks, and there'll be a payout extremely speedily after that. so that the people that want the money get it quickly. I'm not going to say any more on that this month, but please, if you're unsure, just have a chat. Again, it's about being educated. Don't stay in the dark about this. It could be the most expensive mistake that you've made. Finally, just a quick summary of the other services that the Mortgage Home offer. As you can see there, a bit of a bullet point covering anything from bridging into commercial. If you're buying stuff just to flip, then obviously bridging is more relevant. HMOs, holiday let, which includes serviced accommodation within that, and of course auction purchases as well. So finally, take a screen print if you like of this web address. That's a link to our diary. You can access our mortgage advisors to do a free review. You know, if you're not sure about your portfolio, as I mentioned earlier, then get a portfolio health check. We'll do one free of charge for you. Just book an appointment in, and we'll help. You can also do an insurance review as well. So if you want to understand a little bit more about trusts, whether you need one, have one or not, then you can speak to one of our insurance advisor team there. Other than that, as I said right at the start, do hit subscribe to be told of our future videos. And remember, be educated and be successful.